Hey everybody, thanks for joining us again on another episode of the Full Count Show. You got myself here along with Andrew, and we're going to be talking about some interesting topics today that's going to piggyback off of our last episode. That's going to include stocks, inflation, and real estate. So with that, we'll get right to it.
3 balls, 2 strikes, pressure is on. This is where we discuss real estate, property improvement, and business. Together, we'll strategize on how to win. Welcome to the Full Count.
Thanks for joining us. The first topic on our agenda is going to be stocks and the current status of it since the beginning of the year. So, Andrew, with that, I'll let you introduce and we'll go from there.
Yeah, so the stock market hasn't been pretty for the first 6 months of this year, as we all see. I know, Nick, your portfolio is probably not doing well. Mine isn't doing too good, but that's why you diversify, right? So there's certain components that are doing okay. I know gold is down about 1.3% for the first 6 months of the year, which is great. So I have a gold bracelet and gold chain and whatnot. And of course in my portfolio. The stock market's down about 21% for the S&P 500. The NASDAQ is about 29.5% negative. So there hasn't been a lot of safe havens. And it's been pretty scary. But like they say, real estate can be a safe haven. But at the same time, this whole incident with the stock market hasn't been pretty. How have you been feeling, Nick?
Yeah, I mean, like you said, my portfolio has been down. I mean, just around that average that you said, probably about 20%, and it's just been kind of nerve-wracking to watch and look at, and just see it kind of plummet. But I mean, I'm not an avid, huge knowledgeable investor guy, right? I mean, I know some people that are so much more knowledgeable than I am, but I do have my bit of background, being in wealth management and working for JP Morgan Chase and all of that. But I mean, a lot of people do prosper in a down
bear
market.
Markets. Yeah.
Yep. Yeah. And that's actually, I mean, sometimes that's where some of the wealthiest people come from. Yeah, exactly. People look for recessions because they find opportunities in them,
Correct. Yep. I totally agree. And, the reason why the economy or the stock market hasn't been doing well is because of the economy, right? So inflation worry that we have right now has been obviously scary for the markets and overall consumers that are feeling it at the grocery store. I know, Nick, you love to go shopping and buy your groceries, and you probably haven't been feeling too great about that. And then myself, I drive a lot, especially as an agent. I'm all over the place, and I've been feeling it with the gas pump. So it's not been very good. And that's why the stock market is down, because they know that these companies' earnings are going to be a lot lower than they were in the previous quarter. So what do you think, Nick, in terms of like the, GDP going down? And have you looked into that? You have any comments on that?
No, to be honest, I really haven't looked into that too much.
Mm-hmm.
I mean, trade wise, there's differing opinions, and I mean, to get into politics and all of that, right?
I don't want to get into politics maybe in the future, right. But in terms of the GDP, though, I will say that what's the rule of thumb? Like the first 2 quarters negative, technically it's a recession. But then there's this organization that actually calls it 3 to 4 months after the GDP comes up negative for the second one. The first quarter was negative 1.6%. Second quarter is now forecasted to be negative 1.2%, I believe. So that's 2 quarters of GDP down. So technically we're in a recession. However, like I said, 3 to 4 months from now, we'll hear for sure whether we are or not. And I just wanted to point something out I saw in the paper today. The headline is the Fed wary of repeating 1970s errors. So in the 1970s, there was a high up inflation period. So the people in the past felt it like we're feeling it now. However, the Federal Reserve raised rates, and they were raising it very quickly, like currently is happening now. And what they ended up doing was they ended up bringing the rates back down. I've been hearing on the news, I don't know if you've heard, Nick, but there's been some talk about the Fed might bring down rates potentially because of the whole situation with the economy slowing. But what they did in the 70s is they lowered the Fed funds rate, and because they were afraid of the economy going down, right? But inflation kept going up. So that's the problem. So it was like putting a Band-Aid on it, and then it just taken right off, and it was still a problem. So in the 80s, Paul Volcker, the Federal Reserve chairman, he said, this isn't going to happen on my watch. I'm going to raise the Fed funds rate until inflation comes down. So he raised it very high, and it obviously got them into a recession, a very bad one. But the beautiful thing about it was inflation came down. And we're not sure what's going to happen with this current chairman, either if he's going to continue raising these Fed funds rate or if he's going to bring it back down like they did in the 70s. And then several years from now, Nick, we may feel the pain again with another chairman in the Federal Reserve that might raise the Fed funds rate.
Yeah, exactly. I mean, just to give our listeners and viewers an idea of the date. So today's date as of right now, so it's July 13th, 2022. So that was in today's newspaper that Andrew was referencing.
Wall Street Journal.
But,
yep.
Yeah, in the Wall Street Journal. But the Fed does have a pretty hard job, right? I mean, because they don't want to overshoot it. They don't want to increase rates too much, right?
Mm-hmm.
And then have them to be too high for too long and slow things down too much. But then they also don't want to bring them down too soon, right? Because I mean, both those things can cause a recession. So, or it could keep inflation increasing. So it's a very fine line that they're walking. That's for sure.
Yeah, it's a difficult moment for them, especially with the administration, the president, right? They're always in the ear of the Federal Reserve. So they have to take into account what's on their spreadsheets, and then they have to take into account before the Treasury and the president. So it's a difficult job. Some people say, is it a necessary job to have, right? Should we remove the Fed or should we not? That's another topic we can get into. But at this moment in time, the Federal Reserve is very powerful, and we need them at the time for what's going on. So hopefully inflation does come back down, but I don't think it's going to happen, not for a while at least. I think it's projected that the Federal Reserve is going to raise Fed funds rate about 75 basis points higher like they did in June. So we'll see. I don't know. Nobody knows, but we do know that the stock market hasn't been doing well, as we noted earlier, and the stock market might fall again, third quarter, maybe fourth quarter, and maybe even 2023. Who knows? But that's why it's good to diversify and invest into the stock market, dollar cost averaging, and in my opinion, it's good to invest in real estate. What are your takes on it, Nick?
Yeah, no, I agree. And I mean, just to, note again, we're not experts here. We're not giving any type of
not financial
advice. This is just our thoughts, our knowledge, our opinion that we're sharing with you. We'd love to hear, yours. So feel free to put in the comments. We'd love to hear back from you all. But no, I completely agree, Andrew. And I mean, I know you have a lot of, affluential clients in those industries, right, that are a little bit more knowledgeable, a little bit more connected to how the stock market's performing, being affected by inflation and background there. I mean, what have you been hearing from them? Anything specific?
Well, I think that's a good point. So my clientele ranges from, just a modest income all the way up to somewhere in the higher bracket. So teach their own, right? Like I was saying earlier, you and I are feeling it at the grocery store. The higher end clients of mine probably aren't. Maybe they're feeling it more on their vacations, which, we all want to go on vacation, and that's something I hope to do very soon again. But anyways, I'm hearing a lot. And as an agent that helps many people, different incomes, I got to read a lot. And that's why I read the Wall Street Journal all the time. But what I'm hearing from people with more modest incomes, I guess I could say, is they're not too concerned yet, although the gas prices has really affected them. And if it continues to go on further, then I believe it's really going to get a lot worse for them. And therefore, the economy will take a harder turn. In terms of people with the higher incomes, they just feel like the stock market's going to come down a lot more. And they're afraid because they don't know where the bottom is.
Right. Yeah. And I mean, those are all valid points. And to be honest, though, with inflation, at least from my perspective, right, is that
9.1% now, by the way.
Yeah, right. A lot of it is psychological, right? I mean, if you're looking at sociology and the way that people act and think in groups, has a lot to do with how prices are affected, with how inflation is affected.
Oh,
With
you mean
really
like
a good portion of the
perception?
economy. Perception, exactly. Because
Yeah.
prices started to increase overall, generally, right? And then if they stayed that high for a certain amount of time, people almost get used to them. And then that
Mhm.
becomes, you know, I hate using this term, but quote unquote, the new normal, right? And people get desensitized to those prices. And that just becomes the norm. And suppliers, corporations, different industries say, okay, people are willing to pay this price and they're not going to complain about it. So we're going to keep these prices as is, even if, the economy is doing better. Their cost might not necessarily be increasing, et cetera.
I actually disagree with that. I mean,
Yeah.
the suppliers, the producers, the producer price index has been high too. The percentage besides
Yeah,
CPI
that's true.
that I just noted about 9.1, their cost for shipping and things along that nature has been going up, and therefore it's spilling over to the consumer. And I believe that's been happening since 2021. The producers price index has been going up, and it didn't affect CPI right away, and then started spilling over. I do agree with you to some degree that it comes down to like perception of people, that it becomes normal to pay X amount of dollars. But I think when they start to see it, everything around them going up, at the end of the day, when you start seeing a bunch of negative numbers in your bank accounts, it starts to hit home. And that's where I would say I disagree in terms of the perception. I think it does come down to people's pockets. And a lot of people are angry right now.
Yeah, no, they definitely are. I mean, I don't blame them. I'm right there with them, right? So,
Yeah, I mean, to
but
some degree, I'm not feeling too good about certain things, but
yeah,
it is what it is for now, I guess.
yeah, exactly, exactly. But then you have, some of those corporations and suppliers, and producers whose costs necessarily haven't increased, and they're still recording record profits, right? But they've
No,
been
I
increasing their
mean,
prices.
not so much. I mean, that's where you and I disagree on a lot of things, right? I know we've gotten into debates, and it's good. I think that's what makes this
Healthy
conversation
debates.
good. Yeah,
Yeah.
we debate a lot. But I mean, yeah, I'm sure there's some anomalies to that degree, but um, a lot of companies their earnings have been going down. So the earnings that they had, the profit from last quarter and the previous quarter to that was a lot higher. Now it's slowed down. So they're seeing people not spend as much. So they're starting to get hit with it. And then they're also getting hit with just overall cost of their production to go up. And that's why, I think it really is inflation affecting everyone.
Yeah, yeah. And I mean, we're generalizing here, right? But of course there's,
Completely,
outlier
completely.
cases and skew cases. So, um, but I mean, yeah, I think if you're looking at the majority, I agree with you there. That's probably true. So I mean, to get on the topic of real estate and what you've been
Being a
seeing,
hedge.
yeah, yeah, exactly. What you've been seeing there, what feedback you've been getting from your clients, even from contractors and investors who, you know, buy houses, fix and flip, or whatever they're doing
Hmm.
in real estate. What are they saying?
So there's a lot to that. But I guess in terms of like clients, they're still, if they can afford it, they're going to buy the house that they need, or they'll sell it and go into something else. They're feeling it with the mortgage interest rates going up, which has been an issue, and I believe it's going to continue potentially going up. So we're going to see a natural softening, which I think is healthy for the market because it's been going up like 21% per year or along those lines. Obviously, that's a generalization, as I always tell my clients and on my social media. That's a macro perspective. When we speak micro, that's like within your zip code or your city or whatever the case may be. But at a macro standpoint, it's definitely been going up too much to some degree. People have been buying and prices have been going up, but now it's starting to soften. I believe maybe by the end of this year, it'll probably be positive, low single digit number of price appreciation. But people are still buying. I don't see too much of a negative talk just yet. Maybe when the recession headlines come out, maybe we'll see something different. I'd like to follow up on that question with you.
Yeah, yeah, definitely. I mean, I like to see how things change over time for sure.
Hmm.
But I mean, on the topic of just to remind everybody that's, viewing or listening in. So Andrew's actually based in LA. So in more affluent areas, right?
Southern
Of LA.
California, Orange County,
Southern
San Diego
California.
too. Yeah.
Exactly. So if you're out there looking for a place, hit them up. But
thank you. Oh, you know what? Thank you for that plug. I do want to mention too. I know a lot of realtors are probably going to be watching this too. I've already spoken to some that have liked their content. If you're a realtor, we're obviously competing with one another to some degree, but we're also teammates when it comes to going into sales or escrow. But if you have anything off market that you want to share with me, please go ahead. My clients are they're very good, and I've vetted them, and I think it'll be good for your seller. So I just wanted to throw that plug out there. Send me your off markets.
Yeah, same here. Especially, I started to actually get into some wholesaling. So if you guys have any off markets, if you're listening down there in Florida, the New England area, feel free to let me know. But the reason I mentioned, where you were was because, I'm assuming a lot of your clients are wealthier, right? A little bit more affluent, right?
If we're speaking like overall across the nation, maybe, yeah, I would say so. Yeah.
Okay. So do you see them still, or have they in the past mainly bought homes and real estate with cash? Or are you still seeing them take out loans, giving, the state of the interest rates and how they've increased?
I've seen more loans, and then what they do, especially the more affluent community, is they're like their large institutional bank, because they have a lot of their money there in the account. They give them a lower rate than what's out there on the market, so they'll buy it with a loan, or sometimes they'll buy it all cash, and then they'll take the money out and put a mortgage on it. That's just how they beat out everyone else. But I'm still seeing all cash, but I just think this, like, I got into the game of real estate, I think in 2015, and I've been hearing from, people that have been bearish on real estate, like, I'm going to buy when the market crashes. And I've been hearing that since 2015. A lot of those people that told me that I've stayed in touch with, they're still saying the same thing, and they haven't bought. So I think the ones that buy are just doers, and the ones that don't are just going to wait on the sidelines. Who knows when they're going to buy? So I think it's just best to buy whenever you're comfortable and it makes sense for your life. But just going into equity being built in the nation, speaking macro again, in 2022, the first quarter alone, home equity grew 20%, and we're up to 27.8 trillion, which is a new record now, as noted by the Federal Reserve. So $27.8 trillion worth of equity in the United States. Isn't that nuts?
Yeah, that's crazy. Do you see that it's gone up that much because of inflation, or another reason?
In terms of the inflation issue we're going through now, no, not so much. It's a lot. Yes, it is partially because, like, contractors like Steven would be good to expand on this, but contractors are spending a lot more on materials, right? Because of all the things going on with inflation and the shortage of goods and whatnot. But when they do a remodel or expand the square footage, that extra cost that they have spills over to the price, and everyone ends up paying more. But that's just the way it is.
Right. Do you have other real estate agent friends in other areas who are seeing similar things?
I think we're all kind of seeing the same thing, to be honest with you. Overall, we haven't really seen the markets come down just yet. There's a potential that it will come down, and I think it might happen maybe next year, but none of us have a crystal ball. But overall, the market's hot because inventory is so low, and there's a lot of households out there that are looking to buy. So I just think it's insane. And here's a statistic too that I'll share with you. Let me see if I can pull it up here.
While you're looking that up, so regarding the debt piece again, right? Just to harp on that one more time. Do you see real estate investors that you're dealing with still preference leveraging debt over not because of the interest rates?
I mean, they're more cautious, right? When they leverage debt, right? Meaning they take out a loan and get an interest rate of whatever the market that they're in. I mean, yeah, they're still taking out loans, but they're more particular and meticulous about what they're investing in, making sure cash flows and things like that. They're not just going to buy anything just because they want the asset.
Yeah, that's a good point. I mean, that, you know, they're smart about it, right? You got to run the numbers, and
Yeah,
you know, you got to make a judgment for yourself, right? The numbers aren't going to lie. Sometimes you could
correct.
go a little bit in, you know, with emotion, but when you look at the numbers, they're not going to lie to you.
Correct. Now, I want to talk about this stat. So I said $27.8 trillion dollars worth of equity has been built now, right? Which is like the most ever, according to the Fed. 11 trillion of that equity is tappable equity. So it's the amount a homeowner can borrow while holding on to at least 20%. So of that homeowner's equity. So 75% of that $11 trillion equity, those homeowners that have that equity built in their home, their mortgages are below 4%. And I don't know if that sounds crazy to you, Nick, but it's crazy because that tells us that homeowners that are in their home, their mortgage rates at 4% or lower, meaning they're not going anywhere. They're not going to want to sell their house, because if they sell it, then they're going to go somewhere else and get a higher rate. Right now, they're floating around 5.5% to 6%. They're going to want to stick with their 4% or lower interest rates. So that's where that inventory shortage that we've been seeing for many years continue to spill over. That statistic alone is scary enough, because that shows me that there's not going to be a lot of inventory hitting the market. So buyers have to scramble to find a property.
Right. But yeah, I mean, that makes sense. And I haven't thought about that before. But that's actually a very, very valid point. But
I mean, you were a buyer recently, right? I mean, you've been looking in Florida, right? You've been kind of.
Yeah, I mean, I've been looking over the past couple of years, even before COVID started, right?
I've been telling you to buy.
I know.
Now, I mean, I can be telling you to maybe put the brakes and make sure the
Right.
numbers make sense. Before, I would just say buy anything, you know, not anything, but you get the gist of it. Like, you would have been making money.
Yeah, but that's actually a good point, but what I was going to mention was that rates weren't that low really that long ago, right? So
How do you mean?
So let's say, you know, mid-COVID, maybe like a year ago, right? Rates were
3%.
down. Yeah, right. 3-4%.
Mhm.
So it wasn't really that long ago. Yet the supposedly housing shortage, right, where prices drastically increase, was a little over that, maybe like 2 years ago when COVID started, right?
Yeah, so housing prices overall macro across the nation have been going up since like 2012. And then we started seeing a softening around 2019. Mortgage rates hit about 5%. Actually, it did hit 5%. I think it was the third or fourth quarter of 2018. And we started seeing, home prices soften a little bit. So list prices came down. I don't know, like 3-5%, not much. I think at the most. But since we were going into like a recession at that time, COVID ended up happening. It expedited that recession because of everything going on. And then prices just boomed again. So I don't know. I don't even know where I was going with that, but I think I answered one of your questions, right? I hope.
Yeah, you did to an extent. What I was trying to get at was, at least from my understanding, you explaining that these homeowners have mortgages, right, that are low interest rates. So
Correct.
it doesn't make sense for them to sell their house, because then if they go and buy another property and they do need to take out a loan, it's going to be at a much higher rate, right?
Much higher rate, and prices are going to be much higher too. Right.
Exactly.
Since from whenever they bought it, even if it was just a year ago, 2 years ago.
Right.
So the people that own a property that fall in that bracket with a 4% rate or lower, they're not going anywhere unless they were already planning to go and they have the means to do it. But we're seeing people stay in their homes longer. I think about 10 to 12 years ago, people stayed in their home, 8 to 9 years. Now it's going to 13 to 15 years. So people are really staying in their home.
Right. Right.
And just a side note too, why it's important to own. You know how people say, okay, well, my house went up X amount of dollars, right, or percentage. I can't do anything with that unless I sell it, right? I think most people would probably assume that. But you can tap into your equity if you want in a smart fashion. You got to obviously make sure there's a goal in plan and there's an end in sight of what you're trying to do. So two ways to tap into your equity. And I'm not a mortgage person. I'm not licensed in mortgages, but I have an overall idea of it because I've been in the business for about 7 years now, I think. You can do a home equity line of credit. So essentially it's you get a loan on the equity that you built up to whatever amount that you end up doing it. And that interest rate is correlated to some degree to the Fed funds rate. So I think the Fed funds rate right now is about 1.75%. So the HELOC loan that you'll be getting, your interest rate for pulling out that money, the line of credit, is going to be somewhat close to it. It's probably going to be higher, obviously, because there's going to be a margin that the lender needs to make. I don't know, 3-4%, which is still lower than the 5-6% that we're seeing now. The other way is to do a cash out refi, right? So you take out a bunch of cash from your equity and then you borrow on it, and you borrow on it by putting it behind the current mortgage you have, and then you pay the interest rate that's at market value. So that's why the HELOC loan is less expensive, because you're getting a lower interest rate. The cash out refi, you're adding that whatever you're borrowing to the end of your mortgage, and it's going to be higher. So the point is, you can utilize that money if you need it for God knows what. If there's a big recession, you need money for whatever reason, you can pull out that money. If you want to make home improvement, I think this is where Stephen would be very happy. We're going to start seeing more people tap into the equity so they can do improvements on their home, because a lot of them don't want to go anywhere, right?
Yep, exactly. Yeah, actually, so working at JPMC, I mean, given I was, in Manhattan in New York, so a little bit more of an affluent area, but the majority between those two options, the majority of people that, I had come in to pull out equity in their house, they did take out HELOCs, right, rather than cash out refis.
It's lower,
because and there's also, options a lot of the times for revolving HELOCs, right? So home equity lines of credits, where if you don't use anything on it, there's no standing fee. You don't have to pay any interest rate. So it's kind of like
it's like a credit card.
Credit card, exactly. Yeah. Exactly. So
although I will note, everything you said is on the point. Everything always, it's circumstantial too, but I think it's good to have a guest on that's in mortgages that can explain this further and can really break it down, the nitty gritty details, because HELOC is beneficial, but cash out refi can be beneficial too. So it just depends, but I'd love to have a mortgage person come on and explain it further, because I think with real world examples, I think it would really help them out a lot.
Yeah, we could definitely get one of our contacts to come on in one episode. I mean, if you guys like to hear that, leave it in the comments, let us know, and we'll make sure to get somebody on who's an expert in mortgages and lines of credit for sure. But so I guess with that, did we want to hit on any other topics, Andrew, as of right now?
Yeah, I mean, another note about real estate, something that I've been seeing a hot topic even before COVID was like industrial, right? Industrial real estate, especially like warehouses where they hold like inventory that's needs to be refrigerated. So industrial has been a really big component that's been going up exponentially in price. And it's said that it's likely going to continue that route. I've been selling industrial real estate as of late. So I'll tell you this quick story. When COVID happened, when the stock market went down, do you recall how much it went down, Nick? I don't have the ability to pull it up, but I think it went down like 35%, maybe.
I think so. Right? Yeah, something along those lines.
So right before COVID was happening, we were hearing about, lockdowns in China and things like that. My client calls me and says, "Hey, I want to invest a good portion of my money in my portfolio into real estate. Let's get on it right now, because I have a feeling based on my financial advisor that the market's going to take a hit. And rather than keep it in my stock account of whatever he was diversified in, he says, I want to spend it in real estate." So I said, let's do it. And he ends up purchasing an industrial warehouse, office in the front, warehouse in the back. And he did good. He did very good. price went up on it during COVID. It's cash flowing. And a statistic on here that I can read off to you is, let's see here. So there's been a survey.
Just to interrupt you for a second, Andrew. So when you say industrial real estate, you're talking about like industrial warehouses specifically, which is separate from commercial. Right? Like,
well, it is within it is commercial real estate, but commercial real estate, think of it like an octopus, right? Commercial real estate, there's a branch of office, retail, apartment buildings, industrial. Okay. That's what I mean by
it. Industrial would be a part of commercial, is how you're categorizing.
Correct,
it, right?
Correct.
Okay. I just want to make sure everybody's clear on that note so they understand what we're talking about here.
Yeah, so I was telling my client industrial would be good because of what I had been witnessing and reading about industrial being something that would, at least maybe not so much go up or go down, but kind of stabilize. And we've been seeing that that's been an important real estate segment. And it was said by the CBRE survey in April of 2022, they found about 40% of real estate investors were interested in cold storage industrial real estate, up from 7% in 2019. So when you see a large volume of people going from one thing, maybe let's say retail, because retail was good, office was good before COVID, right, to some degree, and they're all now swaying over to industrial or cold storage warehouses. That's where you start seeing movement, where the prices are probably going to continue to go up, especially with the lifestyle changes. We've seen more people are ordering their groceries online and getting it delivered, and all that food needs to be stored somewhere. And that's where industrial comes in. Yeah.
Yep. HelloFresh, all those meal plan services. Right?
HelloFresh is good.
Yeah. There's so many out there.
Yeah, so, exactly.
I mean, they all need space to keep and store their stuff to get you fresh goods, right? So yeah, that's true. And then, I mean, do you think pharmaceuticals, have they taken that at all? So like the store
pharmaceuticals, yeah. I mean, some industrial warehouses, the pharmaceutical supplies need to be refrigerated at a certain degree, so they need to store all their, whatever it is. Obviously, I'm not an expert in that, but they do need to store all their supplies in a given area that's safe and that is well temperatured, and that's where real estate comes into play. So that's been a really good topic, industrial real estate.
As far as places where there's industrial real estate out there by you in LA, is it like further east California? Because I know a lot of Southern California is already built up, so there isn't a lot of room there, right? So where are you seeing a lot of that?
Across the Sun Belt. That's a good question. No, I mean, okay, so let's, like we spoke about in the last episode about COVID and how the people have migrated out of West Coast and East Coast. They're going to the Sun Belt. So yeah, I mean, a lot of California has been built, but there's still a lot of industrial real estate, to be honest. All we got to do is go more inland into the valley of LA, or you can go into Riverside, San Bernardino. There's a lot of opportunity there for industrial real estate. You see a bunch of Amazon storage spaces there too. But as far as like more opportunity for real estate, it would be like Texas, Florida, Arizona.
Yeah.
That would be a spot to go to. And
that's and the Midwest, I'm sure, right?
The Midwest, yeah. One way the viewers can get involved, besides literally buying a space, which can be expensive, or if you have the means, call me or call someone I know and I can connect you. You can buy Reits, right? Reits is a good opportunity. That's basically a stock that holds a bunch of real estate in different segments of commercial real estate, from retail, office, and things like that.
So what does Reits stand for?
Real Estate Investment Trust.
Okay.
So I hold some apartment REITs. I hold some cold storage REITs, and I'm involved. I'm involved in real estate. I own property. I sell property, right? I sell lots and things like that, land, and I own REITs as well. I also, own REITs and land, literally, or farmland. That's another hot one too.
I didn't realize.
How about yourself, though, Nick?
Land. No, I don't own any. Yeah, I don't own any REITs.
Why is that? Let's. No, but why is that though? Because you mentioned you've been wanting to buy property, right?
Yeah.
But you decided not to for whatever reason. I encourage you, Nick, to buy something or invest in REITs eventually, or dollar cost average it. That's what I would do. Yeah. Especially if the market comes down more, the stock market, REITs will be good to buy as it comes down. Dollar cost average.
Yeah, to be honest, I've never really even thought about or considered REITs. As we've been talking about over the past months and my engagements, is I've been looking into more of either long-term or short-term kind of rental properties, right?
Okay.
So that's kind of been my areas of focus as far as what I'm looking for. But that REITs is definitely something I should look more into for sure.
Yeah, because you can own apartment buildings through REITs, right? So
yeah,
I think it's if you don't want to commit, or whoever's listening doesn't want to commit with thousands of dollars into purchasing something, right, and putting your name on title, you could just throw $100 in there, $50, and let it accumulate over time. It's a good way to get involved and profit.
Yeah. So is it more like a share?
Or it's a share.
It's a share of
a company.
Multifamily on a company. Okay.
And there's, I think, 80% of the profit that company makes. Again, I'm not a financial advisor, but I read up on it. I have an understanding. If I have questions, which I always do, I'll ask someone that's licensed. But again, this is not advice. But so a REIT, a company that makes profit, I believe it's 80%. I might be wrong, but I believe it's 80% of that profit has to go directly back to the shareholder through the dividends. So whatever the share is, if it's a 6% dividend, you're going to get 6% back of whatever that share was that you bought it, and you're going to get that in return. And that's why it's a safe investment when it comes to dividends overall. So that's why REITs are a really good thing to get your feet wet to eventually go into real estate.
Yeah. I mean, that might be, another deep dive topic that we could do on another episode for sure. So guys, let us know if you want to know more about that. But
make sure to subscribe too.
Yeah.
Subscribe, comment. Let us know what you think about what we're saying. If you disagree, whether you're Team Nick or Team Andrew when it comes to certain things that we disagree on, I'd like to see a survey.
We'll have more.
I'd like to see a survey of who agrees with me and who agrees with you.
Yeah.
That'd be fun.
Right. Exactly. Yeah. Another topic that we might want to do a deep dive into as well is a number of companies that have been spinning up that are based around investment properties, right? So you could buy a percentage of the property and they treat it as almost an investment portfolio, right? So you buy shares, kind of like you were describing with a REIT.
Kind of like REITs. You're talking like Fundrise or Grant Cardone Capital.
Exactly.
Right, Fundrise.
Exactly.
Yeah.
Right. Yeah, and there's also a new one called Here, which I just came across, and there's some differences between like all those three, right? Which maybe we can go into in another episode.
All I can tell you right now is you got to be very careful with some of those.
Yeah.
I asked the financial. Like yeah, but I asked the financial advisor I know at UBS here in Century City, and he really. I asked him this like 3 years ago. He broke it down wonderfully for me. I don't even want to try and break it down. Maybe I'll follow up and get back to you what he said about it. But you got to be very careful with those. He says he would recommend at that point to get into REITs probably instead of something like that. But I think we should follow up. You know what I want to talk about though? I know we were because it's current events. James Cain died, right? The actor who played Sonny.
Oh yeah,
The Godfather. Yeah. And you being an Italian, I wanted to get your take on it because I watched the movie growing up and I loved it. A lot of life lessons. I know it's it's a crime story, organized crime, but you being an Italian, what do you think about that movie?
Yeah, I mean, I have mixed feelings about The Godfather. I think it's a little stereotypical to Italian Americans. It gives them a little bit of a bad name. I mean, it did good and bad things for Italian Americans, right?
Yeah.
In general, but I actually have so on my dad's side, there's a number of his cousins, mostly like second cousins, that kind of stuff, and then also friends that he grew up with there. And so he grew up in Brooklyn and Bensonhurst in New York.
Okay.
That's actually where I was born, but there's a number of them in those movies. So he was a little more, linked into what was going on there. But I mean, overall, like I said, but I have a mixed kind of
Mixed
perspective
feelings.
because it in a way it comes across a little stereotypical.
Yeah.
And obviously a little violent, and a lot of Italian Americans aren't necessarily that way.
They're hardworking. Yeah, I mean,
Yeah,
they're
exactly.
hardworking, family oriented. It's kind of like the Mexican community as well. Value family, number one. Value work. But keep going. I want you to expand a little bit more on your feelings towards the movie, because I think Italians got a bad rap, and especially like in the East Coast when they came over. And I think that's how
completely.
organized crime kind of spurred even further than what it came from Italy. But
Right.
what exactly did you like? Give me an example what you didn't like about the movie that kind of made Italians look bad, or whatever.
Yeah, I mean, I haven't watched them in a while, to be honest. I mean, they're not my type of movie either.
They're my
couldn't go
type of
through it.
movie, man. I've watched it like I don't know, five times the first one.
Yeah. I mean, I think a more accurate description of Italian Americans is probably, which is similar, but is the Bronx Tale, right? I'm a
It's a
much
great
bigger
movie.
fan, of the Bronx Tale than I am of any of the Godfather movies. But my type of like Italian American movies, the Rocky series, big fan of that.
Oh yeah, the boxer. Yeah, heck yeah, that's
right.
a good
Sylvester
movie.
Stallone. Come on,
Yeah. I was like, no, because I was thinking mob. I'm like the Rocky. I'm like, oh, of course, the boxing movie. That's a great movie of
movies,
the underdog
movies.
coming up.
Mm-hmm.
But I don't know. I mean, I told you about this guy named Michael Franzese. He's a very famous mobster. He said the Godfather movie actually, obviously, like you said, I agree with you. It does stereotype a bit, but the current mobsters at the time when the Godfather came out, they decided to dress a little bit better, have more etiquette when it comes to how they act, I mean, a lot of them I'm sure were gentleman-like, but they became even more gentleman-like. It like set the standard to be a quality mobster per se. Luckily, the RICO Act came in with Giuliani and kind of diminished that, because obviously crime isn't good. But I would have never, think it's a good thing. But I thought it was good. I really got into the growing up, James Cain being Sonny, right? He was like the explosive character.
Yeah.
Obviously, his ending wasn't very well because of that. But I always connected with that character. And as I got a little older, late teens to 20s, I started getting more into like Michael Corleone, because I was thinking, did I mispronounce it? But whatever. He was a very strategic, stoic guy, and I decided with my life I wanted to go ahead and immerse myself more into that type of quality of a person, because being explosive and passionate about certain things can lead you down a bad path, but still can being too stoic, right?
Yeah, right. Yeah.
So now that I'm even older, now that I hit 30, I like the what's his name, Tom Hagen, Robert Duvall's character. He's more of an intellect, more of an advisor. He's more of the middle ground between the two to some degree, and I think that's the way to be an advisor and things like that. So I think that's the best I got out of it, because what we're seeing in society now, kind of going back down to full count, people just dealing the cards you're dealt with in life and working hard and going under pressure, not complaining. I just feel like there's a lot of Fredos out there, right? A lot of people complaining and things like that. He was the character that would always not do well, had issues emotionally too, which, all of us kind of do, but he really was down on his luck.
Yeah. I mean, to be honest, I really haven't watched those movies.
You got to watch it, dude. You really got to go back.
Yeah. Well, I mean, I watched The Godfather, but some of his other, like roles and that kind of stuff, I'm not too familiar with him.
Okay. You let me down a little bit. I've spoken to other Italians. I love that.
Yeah, I don't know. Like I said, it's too much. It's not my type of Italian.
Got it.
I'm more
Bronx Tale's
being
good.
being a dual citizen. I'm more of like the original hometown, type of Italian. I don't know. I guess I take it more after my mom's side.
Explain that, because I don't think people know. Explain it though.
Yeah. So
what's that mean?
Actual Italian, right? Like, so from Italy, Italian,
Okay.
which is different.
I know you go to Italy a lot, so.
Yeah, which is going to be different than, like Spaniards from Spain and then Spanish from South America, per se. There's going to be big cultural differences, ethnic differences, that kind of stuff, right? So I don't know. I just feel as though Italian Americans are given a certain type of stereotypical view to them.
Even today? Or
yeah, even today. And I mean, there's a number of groups which I actually follow, and I listen to their podcasts and watch some of their channels and content. But they go into a little bit deeper detail on this, and they create some entertaining videos on how it was, how my parents were, especially my dad, when I was growing up, right? And it's funny because it's true, but it's also a little concerning because it's true. So one of them is, growing up Italian, and others hardcore Italian. So feel free to go on and look at some of their content, and you'll see what I mean. But also, if you listen to Sebastian Maniscalco,
the comedian,
right?
Oh
the comedian,
my God, he's great.
He's one of my favorites.
He's good.
Yeah, but he's one of my favorites because everything he says I can relate to growing up as an Italian American, and it's completely true, right? So
I think you introduced me to him. You introduced me to him actually when I was in Boston after we went to Little Italy, right? I think that's what it's called, somewhere within Boston community.
Yeah,
is that right?
End. Yep.
The North End. Yeah, we went back to your place and we watched them on TV. He's great, and I've been following him ever since. So I get what you're saying. And I'm not Italian, but I relate to a lot of the stuff he talks about in his bits.
Yeah. So. That's true. He's one of my favorites. So if you guys haven't heard of him, look him up. He's great. But I know we've gone off on a little bit of a tangent here from what we were talking about. Yeah, but I mean, if you guys want to hear more about my background, Andrew's background, we're happy to talk more on that as well. But all right, I think we'll wrap it up from here, right? So if you guys have any thoughts, questions, concerns, feedback for us, let us know. If you like what you're hearing, watching, listening to, subscribe, tell your friends about us. And, like we said, we'll create the content that you guys want to hear and grow with you.
Yeah, we're getting all the kinks out still. We still got a lot we're learning with. There's a learning curve in doing these YouTube channels and the podcast and whatnot, but we'll get there with you. So we appreciate you understanding, and definitely comment, subscribe, and tell people about it.
All right. And with that, we'll put a wrap on it.
All right. See you guys.
Bye, all.